Hello and welcome. Professor Chandrasekhar, it's a pleasure to have you with us. Today we are going to really discuss the issue of what is happening to the financial markets, particularly now that we have 1 year after Lehman Brothers collapsed. Now, by all accounts, the money markets seem to have recovered, but the underlying causes which caused the collapse of the Lehman Brothers still seem to be there. How would you think is the prognosis for the future?
Well, I think first we have to look at why actually the financial system has in some sense been retrieved from the brink. And I think there are two elements among many which are particularly important. The first, of course, is that there were a number of big banks which were considered too big to fail, into which a huge amount of capital was injected by the governments in Europe and the United States, of course. So what you really had is a recapitalization in which the state became owner of most of these banks, but actually didn't exercise the right of ownership. It still remains operated and run by the management and the private shareholders in large measure. The second is that they allowed them to ride the yield curve. Basically, you're borrowing short-term, in the short-term market at near zero interest rates because of the huge liquidity being provided by the Fed. And sometimes you're just reinvesting that money in treasury bonds, for example, and getting a much higher interest rate, which, of course, with longer maturity periods. So you borrow short and you keep, rotating this, and you get this much higher interest rate, and partly your profits begin to improve, because obviously you're getting, for nothing virtually, you're getting this spread between. So the way I look at it is, there is an element, or a very large element of the revival, which essentially is a reflection of the fact that the so-called stimulus was in substantial measure the use of public money, taxpayers' money, to actually not merely shore up to prevent insolvency in the financial system, of course with some mergers and so on, but also using it to provide profits, to actually offer a virtual subsidy, by the state being both the lender and the borrower from the same system, in which the lending rates are much lower than the borrowing rates. Now, the point is that essentially, while it has helped, as I said, bring the system back from the brink, it's also reduced the pressure and increased the power of lobbies which are trying to prevent dealing with all of the problems which actually created the crisis in the first instance. So whether it be the question of cutting large firms, financial firms down to size, whether it's a question of controlling the kind of financial assets they issue. You have some kind of a financial safety commission, which financial product safety commission, which a number of recommendations which have come out to put out, or whether it be the question of how do you deal with the rating agencies. You must be reading about Moody's now having been taken to court by somebody who actually says that, who was an insider, and who says that they indulged in fraud, that the base assets on which derivatives were built were actually treated as poor, but the derivative was actually declared a good investment. So all of these and many more of the problems which lay in the financial, which led up to the crisis in the financial system, including, of course, the freedom to straddle large segments, different segments of the financial sector, so that you have these supermarkets with huge conflicts of interest, that all of that hasn't changed. And we've had a number of sources from which recommendations have come: the Turner Review, the Geithner Plan, the EU plan, and so on and so forth. What came out of Britain, of course, was the Turner, but besides that, we had other recommendations. We've progressed nowhere on this. So the way I look at it is, you come back from the brink, but it's not too distant to go back there.
So basically, if a revival has taken place, a crisis could be still behind immediately following this.
Yeah, in fact, I would think that the reason for that is not just that you haven't resolved the financial problem, but because you've sort of temporarily resolved the problem of this in this manner, including injecting huge amounts of liquidity into the system. What really has happened is, even as far as the real economy revival is concerned, Part of it, of course, is because of the spending by the state. But a large part of it is because you're once again creating a credit bubble. And you're actually having two versions of that credit bubble. One is you're trying to bring people back to market based on borrowed incomes. Not incomes, but borrowed resources. And you're allowing speculators to borrow from the market. Look at all emerging markets. Besides global markets, but emerging markets in particular. A huge rush of capital into these markets, and most of this is because of this excess liquidity in the global system, in which you can borrow cheap. It's a carry trade. You borrow cheap either in the dollar market or you borrow in the euro market, and you go and invest in these countries where, because you're investing, you get returns of 20%, 25%, and obviously you'll show huge profits.
If you really look at it, at what is happening to the real economy in that sense, which is really the job market, which remains still depressed.
Yeah.
Only the rate of job loss has come down.
Yeah, sure.
The job employment has not improved. And secondly, the savings of the people have increased, which means they're really spending less. So in both senses, in that sense, the real economy is really being bumped up by what you said, this excess liquidity being pumped into the market, which has its limits. So are we likely to see a long-term also, in some sense, a creeping crisis of the United States economy, which is really the key one in this case?
Yeah, well, we have two things. One is, as you said, what they are saying is, we've touched bottom. Now that doesn't mean you cannot just keep bumping along the bottom. It doesn't necessarily mean that you'll have a significant recovery, even if it's a mild recovery, which basically says that the system doesn't get corrected, that it goes back to where it was, or somewhere near where it was. The second, of course, is that even to the extent that you're achieving whatever you're doing, either just making sure you've hit the trough or getting a bit of a recovery, if that is predicated on the same set of stimuli which rests on this kind of fragility, this kind of a bubble which ran the real economy for a long period of time, then what you're saying is, it's the same double jeopardy situation. You can have a financial crisis which can affect the real economy, and the real economy can go into crisis because of the fact that once you have that, the bubble which keeps the real economy going would have gone bust.
So in some sense, the recovery has actually let off the pressure on the financial system to reform. And that is one of the problems, but that's only one of the problems. The other problem is the US has been living well beyond its means for donkey's years, with wars abroad, pumping money out and so on, living in a deficit economy. So in that sense, we are also likely perhaps to see a decline of the United States in the not possibly in the near future, but in the future.
The way, see, the point is, let me put it this way. There are two features which give, let's say, a country and its currency hegemony in the world system. One, of course, it's a competitive power. It's the sort of fountainhead of innovation, of productivity increase. It's able to capture world markets. It firms up global leaders and so on. The other comes from the fact that it is a military power, which creates confidence in the country and its currency. People think they're not going to let it go because they are the hegemon. I think what we've actually seen over, let's say, the last 25 years, I would say. First, there was clear loss by the time you got to the 70s and 80s, clear loss of competitiveness as far as the United States was concerned. The second is that it's a convincing military power has also been under challenge. It's just not, you can go back to Vietnam and then, look at Iraq. People thought that they're going to go in and come out and, look at Afghanistan, small country. They're not able to do anything. So, so even the belief that actually it's a successful military power is under question. So we have to look for an answer somewhere else. And I think it lies in the fact that the rest of the world, in particular, of course, the other developed capitalist countries, require the United States to keep policing the world, because they feel that if they get into that act, the situation can even get worse. So they find the need to protect the dollar. And of course, there exists some countries like China, which may have a different view on this, but which needs the United States as a market, and therefore needs the dollar to remain relatively strong. So I don't think it's the old notion of the hegemon. It's a completely different hegemonic role, which at the moment I don't see. I mean, for one kind of world to end, you need another kind of world to emerge.
Thanks. So we will come back on the issue of the global architecture that you are touching upon, and in the next session.